Imagine you are trying to make the perfect meal, adding every single ingredient you can think of. At some point, all those extra flavors start to muddy the waters, right? Your careful balance can turn into a jumbled mess. In investing, trying to add too many different investments to your portfolio can lead to a similar situation. It is commonly known as diversification. Instead of enhancing your returns or reducing risk further, you might actually dilute your gains and make your portfolio much harder to manage effectively. The main reason this happens is due to the principle of diminishing returns when it comes to diversification. Initially, adding different assets like stocks, bonds, and real estate significantly reduces your overall portfolio risk because they often react differently to market events. However, after a certain point, adding even more assets provides very little additional risk reduction. For example, if you already own shares into 100 different companies across various industries, adding another to 100 companies to your portfolio will likely not offer any significant new risk benefits. Instead, these new additions will probably track very closely with your existing investments or dilute the impact of your best-performing assets. Furthermore, excessive diversification often leads to increased complexity and higher costs. Each additional investment might come with its own management fees, trading commissions, or research requirements. This means you spend more time and money managing your portfolio, potentially eroding any marginal gains you might have otherwise achieved. To avoid falling into the trap of diversification, you should focus on smart, strategic diversification rather than simply accumulating as many different investments as possible. Start by understanding your risk tolerance and financial goals, then choose a manageable number of well-understood assets or funds that align with those objectives. Consider using broadly diversified exchange-traded funds or mutual funds, which inherently offer exposure to hundreds or thousands of underlying assets in a single purchase. This approach provides excellent diversification without the need to individually select and monitor an overwhelming number of securities. Regularly review your portfolio to ensure each holding serves a clear purpose and avoids unnecessary overlap. This concept of diversification, a term popularized by financial experts, highlights that there is a sweet spot for diversification. It is about thoughtfully spreading your investments to balance risk and potential return, not just accumulating them indiscriminately. The goal is to maximize your reward for the amount of risk you are willing to take on, without spreading yourself so thin that your best investment opportunities get lost in the crowd. Ultimately, the goal is not to have the most investments, but to have the right investments that efficiently contribute to your financial well-being. By understanding the pitfalls of over-diversification, you can build a robust, diversified portfolio that is both effective and easy to manage, helping you confidently work towards your long-term financial aspirations.